Before the dollar ruled the world, America tied its entire economy to a metal you could hold in your hand. Gold wasn't just wealth, it was the system. It built trust in a fragile young nation, stabilized trade, and convinced skeptics the U.S. could pay its debts. But that same golden anchor came with a hidden cost. It limited how fast the economy could grow and who controlled the money supply. So why did early America choose gold, and what did it sacrifice to keep that promise? The gold standard tied the value of U.S. money directly to a fixed amount of gold, creating a system of trust in early American finance. In the late 18th and 19th centuries, the United States was still a fragile, developing nation with a patchwork of state banks issuing their own paper money. Without a consistent system, people often questioned whether a banknote was actually worth what it claimed. The gold standard helped solve that problem by linking paper currency to something tangible and universally valued, gold. Under this system, a dollar wasn't just a promise, it was theoretically redeemable for a specific amount of gold held in reserve. This convertibility built confidence among citizens, merchants, and foreign investors because it reduced uncertainty about the value of money. Alexander Hamilton, the first Secretary of the Treasury, strongly supported systems that would stabilize the young nation's finances. And while the U.S. experimented with both gold and silver in a bimetallic system early on, gold increasingly became the anchor of credibility. The result was a more predictable monetary environment where people trusted that their savings would hold value over time. This trust was critical in a country trying to attract investment, expand trade, and unify its economy across vast distances. Without that shared confidence, economic growth would have been much slower and far more chaotic. By limiting how much money could be issued, the gold standard restrained inflation but also restricted economic flexibility during crises. Because every dollar had to be backed by a fixed quantity of gold, the government and banks could not simply print more money whenever they wanted. This created a natural brake on inflation, preventing the kind of runaway price increases that can occur when currency is overproduced. For everyday Americans, this meant that prices were relatively stable over long periods, and savings retained their value. However, this same constraint became a serious problem during economic downturns. When the economy slowed or financial panic struck, there was often not enough money circulating to support recovery. Banks couldn't easily expand credit, and businesses struggled to access capital. A clear example of this tension appeared during the Panic of 1893, when bank failures and unemployment surged. The rigid link to gold limited the government's ability to respond aggressively. Instead of injecting liquidity into the economy, policymakers were forced to defend gold reserves, sometimes worsening the downturn. This trade-off, stability versus flexibility, defined the gold standard era. While it protected against inflation and reckless monetary expansion, it also made the economy more vulnerable to prolonged recessions, highlighting a fundamental tension that would shape debates about money for decades. The gold standard strengthened America's position in global trade by aligning its currency with other gold-backed economies. During the 19th century, many major economies, including Great Britain, adopted the gold standard, creating an international system where currencies were all tied to fixed amounts of gold. This made exchange rates between countries relatively stable and predictable, which was crucial for trade. For American exporters and importers, this meant fewer surprises when dealing with foreign markets. A merchant in New York could confidently trade with a partner in London, knowing that both currencies were anchored to the same underlying value. This predictability reduced the risk of currency fluctuations, wiping out profits, and made long-distance commerce more efficient. As the United States industrialized and expanded its economic reach, this alignment helped it integrate into the global economy. It also made American financial markets more attractive to foreign investors, who saw gold-backed currency as a sign of reliability and discipline. However, this system also meant that the U.S. was influenced by global gold flows. If gold left the country due to trade imbalances or financial stress, it could tighten the domestic money supply and slow economic activity. In this way, the gold standard connected the American economy to a broader global system, amplifying both its opportunities and its vulnerabilities. Conflicts over the gold standard revealed deep divides between industrial and agricultural America in the late 19th century. While bankers, industrialists, and many urban interests supported gold for its stability, farmers and debtors often saw it as a constraint that worked against them. In rural America, especially in the West and South, farmers were heavily dependent on credit and vulnerable to falling crop prices. Under the gold standard, the limited money supply often led to deflation, meaning prices for goods dropped over time. While that might sound beneficial, it actually made debts harder to repay because the value of money increased. Farmers found themselves paying back loans with dollars that were more valuable than the ones they had borrowed. This led to growing political movements demanding the expansion of the money supply through silver coinage, known as the Free Silver Movement. Figures like William Jennings Bryan famously argued against the gold standard, declaring that Americans should not be crucified on a cross of gold. This wasn't just an economic debate, it was a struggle over who the monetary system should serve. The conflict highlighted how a single financial policy could have very different effects depending on one's position in the economy, and it shaped national politics during a critical period of American development. The eventual move away from the gold standard reflected the need for a more flexible monetary system in a modern industrial economy. As the United States entered the 20th century, its economy became more complex, interconnected, and prone to large-scale financial swings. The rigid constraints of the gold standard increasingly clashed with the demands of managing a modern economy. This tension became especially clear during the Great Depression of the 1930s, when banks failed, unemployment soared, and deflation took hold. Under the gold standard, the government's ability to respond was severely limited because expanding the money supply risked depleting gold reserves. In 1933, President Franklin D. Roosevelt took a dramatic step by suspending gold convertibility for Americans and later devaluing the dollar relative to gold. This marked a turning point, signaling a shift toward a system where monetary policy could be used more actively to stabilize the economy. Eventually, the U.S. would move even further away from gold, culminating in the end of the international gold standard in 1971 under President Richard Nixon. The transition reflected a broader realization. While gold provided discipline and trust, it also imposed constraints that could be damaging in times of crisis. Moving beyond it allowed policymakers greater flexibility to manage inflation, employment, and economic growth in a rapidly changing world.